Chapter 5, Part 3. Now we're going to look at margin of safety, targeted sales, and operating leverage. All of these use the contribution margin, so that's why we had to go over that first, and we will review that. Now, common indicators of risk. Margin of safety is a good thing to look at because it shows you the excess of expected sales over your break-even sales. Operating leverage, the relative amount of fixed and variable costs that make up a company's total cost. Operating leverage tells you how low the revenue can go before you start losing money. Okay? So, let's start with margin of safety. It's the excess of expected sales over break-even sales. Drop in sales that the company can absorb before incurring a loss and used to evaluate the risk of current operations as well as the risk of new plans. Margin of safety in units and dollars and percentages. So, margin of safety equals expected sales in units minus break-even sales in units. Margin of safety as a percentage can be calculated by taking the margin of safety in units divided by the expected sales in units. Or you can look at margin of safety in dollars, which is expected sales minus break-even sales. Now, again, you can get margin of safety as a percentage if you divided the margin of safety in dollars divided by the expected sales in dollars. So you have two ways of getting margin of safety as a percentage. Now, the other thing to remember is that different sales levels have different margins of safety. So margin of safety, once you calculate it, only applies for that level of sales. So you have to recalculate it every time sales change. So margin of safety. First, again, I told you have to calculate the contribution margin, which, as we know, is our contribution margin in dollars divided by sales. And in this case, it's 20%. Now, determine break-even sales is our fixed cost divided by our contribution margin ratio. So it tells us our break-even sales is $1,620,000. Margin of safety in sales is going to be our current sales level minus break-even sales, which tells us it's $540,000 in sales is our margin of safety. Now, I like the percentage better because what that tells you is that's how much sales can drop without you starting to lose money. What is the margin safety if net income is $162,000? Let's take a look at that. Now, here's how we figure this out. We know that the net income is going to be $162,000. We know our fixed costs don't change, and we know our contribution margin ratio, which is going to be our fixed cost plus our income, which gives us $486,000. We're going to divide that by 20% to get our revenue, because that's how you calculate your sales. And we're going to take the sales times 80%, because that's what percentage is variable cost. So our margin of safety is going to be 33.3% if our sales are at $2,430,000. Like I told you, it changes, which tells us again sales at this level. At $2,430,000 in sales, it can drop 33% before we start to incur losses. Just remember, again, it changes at each sales level. Now, here's a nice one. We're going to go through a bunch of different ratios, and we have a company within the relevant range because it's 0 to 200,000, and we're going to have 130,000 units, and we sell them at $20 each. We have a variable cost by unit, which is what we need, and we have our fixed cost in total, which we also need. So, we're going to add up all our variable costs per unit to get our total variable cost per unit. And that's how we get our contribution margin. Again, that's how we got that number, and these, our total fixed costs are going to be $290,000. So our contribution margin ratio is going to be our $2.50 divided by our sales per unit, And our total contribution margin is going to be $2,600,000, which is our sales of 130,000 units times $20 times 0.25, which is 325,000. That's our contribution margin. Now we're going to use that to solve our next problems. So, what would the company's operating income be at 160,000 units? We're going to take all we need to do is take our contribution margin times our per unit times our volume, and that tells us how much we have left over to cover our fixed costs. Minus our fixed costs tell us we would have an operating income of $109,900. Now, what if the operating income, if sales are $4,500,000? So, our contribution margin is $562 less our fixed costs, and now we have operating income of $272,400 at that level of sales. Now, if you notice, when we looked at units, we took it times the contribution margin per unit, and when we looked at sales dollars, we used the contribution margin ratio. Now, what is the break-even point in units and dollars? Fixed expenses divided by the contribution margin tells us that it's in units is 116,040. That's what we have to sell just to break even. That's our minimum amount we got to sell. Or we have to generate sales of $2,320,800 to break even in sales. Now let's look at targeted. How do we come up with our sales if we have a targeted income? We use the same formula we use for break even, except now we add the amount of additional or the profit we want to generate. And we can do this in dollars or units. So let's take a look at our problem again. How many units would you need to sell to make monthly profits of $260,100? So we would take our fixed cost plus our profit, divide it by our contribution margin, and it would tell us we'd have to sell 220,080 units. What if labor costs go up 10% and fixed costs increase by 22,500? What is the new break even? So we would come up with our total variable cost per unit minus our sales price, and we get now we have $1.80 contribution per unit, and now we have our fixed costs go up to $173,667. So that would be our new break-even point in units. Now, what is the margin of safety in dollars and as a percentage of sales? We would take our break-even in sales, and we would subtract that from our sales, and we would tell at this level, $2,006,000, we have $279,200 as a margin of safety. I like a percentage better. And that tells you that sales can drop 14% before you need to make cuts to make money. Now, the last thing we're going to look at is our operating leverage. I really like this one. Okay, operating leverage. Operating leverage, a measure of the fraction of the fixed costs that make up total costs. It's the degree, a measure of the effect of change in level of sales on income. It's going to be your contribution margin divided by your income. So let's take a look at an example. So what's the company's operating leverage? So we would take our sales, 130,000 times 20, less our variable costs, and that would be our operating income at this level. We're then going to take our contribution margin of $325 divided by our operating income, and it tells us that our operating leverage is 9.31. Well, what does that mean? Well, here's an example. What would happen if sales volume increased by 7%? It would mean that you would take that times the operating leverage, and what it tells you, if sales increased 7%, your net income would increase 65.2%. That's pretty good. So let's take a look at another example. Compute the company's operating leverage. In this example, we take our 432 divided by our net income, and it's 4. If sales decrease by 5% in the next year, what will the company's income be? So we take 5% times the operating leverage, which tells us our net income is going to decrease by 20%. So if we take our net income of 108 times 80% minus our 20% drop, it tells us our net income is going to decrease to $86,400. Now let's prove that correct. First, we take our contribution margin, and we then look at the drop in our contribution margin based on that. And our income is going to go to $86,400 because it's a 5% drop. So let's look at our contribution margin statement. So we know our fixed costs are going to stay the same. They don't change, but we know our income now is going to be $86,400. We're going to turn around and we are going to add those two together, and that tells us our contribution margin, but remember the percentage doesn't change. So to get our sales, we're going to take our, and our sales we know are going to be $2,160,000 minus the 108, which is our drop in sales. Our variable costs are going to be 80%, and that gives us our, if you add all of that together and subtract out, we get our net income of $86,400, and that concludes part 3.